This is Ethan, CFA Charterholder and investment professional, and today I'm going to clear the air on SCHD, which is, quote, dropping like a rock, down 12 out of the last 13 days, while growth oriented ETFs like SCHG are actually up. There's a lot of blatantly false information out there, so I'm going to spend a minute or so setting the record straight on three false reasons I've heard for the drop, then give you the three biggest real reasons why SCHD is down, and finish with how to approach it going forward. Let's start by quickly debunking a few things I've heard about this from other YouTubers. One, it's down because treasury rates are staying higher, so people would rather stay in money markets for yield. What? No. This is wrong in so many ways. First of all, money markets or other treasury bonds and SCHD, yeah, they both pay dividends, but I don't think anyone is dumb enough to think that they're actually competitors aiming to do the same thing. Well, I guess maybe there is at least one person, but probably nobody watching this channel believes that. Second of all, higher interest rates have a more negative impact on growth companies than value companies. So to say that value oriented SCHD did poorly because rates stayed high makes no sense. I mean, did you see what happened in 2022? SCHD was up while growth oriented SCHG was down almost 19% as rates rose dramatically. The reason that interest rates impact growth companies more than value companies is because the value of a company is basically the value of all their future cash flows discounted back to their present value. So, put simply, if they're expecting to make $105 of earnings per share next year and interest rates are 5%, then next year's $105 of earnings are worth $100 today. Because if you'd invested $100 today at a 5% interest rate, you would have $105 in 1 year. The higher interest rates are, the more you have to discount those future earnings to get back to present value. And here's the important part for this case. The further away those earnings are, the more they'll have to be discounted back. It's just like compounding in reverse. If you compound over 5 years, you're going to earn a lot more money than if you compound over 1 year, and vice versa. If you have to discount back earnings that are 5 years into the future, they're going to be worth less in today's dollars than if they were only 1 year in the future. Growth companies, by definition, are projected to grow faster than companies that are not growth companies. So more of their value comes from projected earnings that are further away in the future. So, of course, rising rates hurts them more. It discounts their earnings more than other companies' earnings because more of their earnings come further away in the future. So to say that value-oriented companies, like dividend payers, did worse than growth companies because interest rates rose, well, it just doesn't make any sense at all and shows a complete lack of understanding of how investing actually works. Line number two is that SCHD is down because people are just buying a lot of hot AI stocks right now. Okay, well, one, is that new in the last 2 weeks? No, definitely not. And two, would that have impact on other stocks? Also, no. If someone wants to buy a lot of apples, it doesn't impact the price of oranges. It only impacts the price of apples. Line number three is that SCHD is down because dividend stocks don't do well in booming stock markets. Again, what are you talking about? Sure, they don't usually do as well as other stocks in most booming stock markets, but they don't go down. Here's the long-term chart of SCHD in blue and VU, the Vanguard S&P 500 ETF, in red. Yes, VU has pulled ahead since the beginning of 2023, but does this look like SCHD usually goes down when VU is going up? No, of course not. So that explanation also makes no sense. Here are the three real reasons that SCHD has been falling. Reason number one is that SCHD owns a lot of oil stocks, which make up about 12% of SCHD versus only about 3% of the S&P 500, and oil stocks were down a lot. That's SPY for the S&P 500 in red and SCHD in blue, and then XOP, an oil and gas ETF, in green. We all know Trump is pro-oil and gas, and one of the three pillars of his Treasury Secretary nominee Scott Bessent's 333 plan is expanding oil production. Of course, this also comes at a time when Saudi Arabia isn't in the mood to cut production since they need the oil money to invest in other industries and rebalance their economy, and Russia isn't in the mood to cut oil production because they're trying to fund a war and save their economy. So what does more production mean? Well, it means more supply, and all else equal, the same level of demand, which would lead to falling oil prices and thus falling stock prices. As you can see from the bottom chart, the oil prices are now expected to fall for the next 3 years. Reason number two is that SCHD owns a lot of bank stocks, which, like oil, are also about 12% of SCHD versus only about 3% of the S&P 500. They've also been down a lot, as you can see from the light blue line, which is KBWB, a bank ETF from Invesco. More specifically, they own mostly smaller regional banks, which are down even more than the big banks. A lot of them have been posting weak results over the last couple weeks, and they've been hurt because the yield curve has steepened. The red line is where Treasury yields were on November 29th, and the blue line is where they were on December 19th, the period I've been showing in all these other charts where SHD has fallen. What you can see is that the Fed actually lowered rates during this period. So rates on the short end of the yield curve, like on the left, are lower than they were before. However, inflation expectations have risen and future rate cut expectations have fallen, which has pushed up medium and long-term interest rates. Remember the whole Silicon Valley Bank saga last year when a bunch of regional banks were failing because they owned a lot of long-term treasury bonds that were down significantly as interest rates were rising? We explained what happened in this video if you missed it. Well, they still own them, and when long-term interest rates rise a lot in a short period of time, that's bad for a lot of regional banks. That is how interest rates impacted SCHD, not because people decided to buy treasury bonds instead of dividend stocks, and not because interest rates stayed high, since some of them actually fell while others rose. Reason number three is not so much why SCHD was down, but why it did so much worse than the S&P 500 and more growth-oriented ETFs like SCHG. That's because it owns 0 Magnificent 7 stocks, which make up about a third of the S&P 500 and about half of SCHG, and those were up a lot. So to recap, the three main reasons that SCHD has struggled relative to the S&P 500 and struggled even more relative to growth-oriented ETFs are because it owns a lot of oil and bank stocks, which did poorly, and it doesn't own any Magnificent 7 stocks, which did really well. Combined, oil and bank stocks make up about 24% of SCHD versus only 6% of the S&P 500 and even less of most growth-oriented ETFs, while the Magnificent 7 stocks make up about a third of the S&P and half of a lot of growth ETFs, but they aren't held at all in SCHD. What we've done here is a very rudimentary version of what's called attribution, which is something institutional investors ask for all the time. It's basically a way to quantify why something did well or poorly, either in absolute terms or relative to a benchmark. So, where do we go from here? Well, I'll leave you with one key piece of investing wisdom that'll help you for the rest of your life. Don't get too caught up in short-term moves. You'll drive yourself crazy. This was a less than 10% fall over a less than 2-week period. Welcome to the stock market. Even a fund like SCHD is not immune to volatility, but the beauty of that is that it works both ways. Sometimes it'll be up a lot in a couple weeks. It's generally not smart to react too much to that either. To illustrate this, let me take you through a simple exercise. How confident are you that the stock market will be up tomorrow? For me, it's basically 50-50. Maybe 60-40 since it's usually up, but I have absolutely zero insight into that whatsoever. It's impossible to predict. How about over the next year? Still, we don't know, but it's definitely a better chance than over just one day. How about over 10 years? I am nearly 100% confident that the S&P 500 will be up over the next 10 years. I'm also fully 100% confident that there will be many, many, many times over the next 10 years where SCHD is up at least 5% in a 2-week period and where it's down at least 5% in a 2-week period. And I'm also 100% confident that there will be many times where it beats and trails growth stocks over a 2-week period. What happens in a 2-week period tells you nothing about what's coming next. So, good or bad, it's usually best to just not react to it. When you build a diversified portfolio, like let's say you owned SCHD and SCHG, something will always be doing better than something else. But often, when one thing does badly, another will do well. In this case, some of the things that SCHG held a lot of did well, while a lot of the things that SCHD held a lot of did poorly. In 2022, it was the opposite. If you'd just finished 2022 with the conclusion that SCHG sucks because SCHD did way better, I'll just own that, it wouldn't have worked out very well. So if you stay diversified and focus on the long term, you can avoid the bad timing decisions that come with chasing hot funds and avoid the headaches that come with the inevitable short-term moves. Ultimately, that is how you become a great investor. If what I'm saying is a lot easier said than done, you're not alone. That's why we put together the entire Psychology of Money series to help you overcome those mental challenges that come with investing. This is free on our YouTube channel, by the way. If you enjoyed this video, hit that like button, leave a comment with what you'd want us to cover next, and be sure to subscribe so you won't miss it. And if you want to continue the investment conversation with my partner Kyle and I, you can click the link in the description to join our Discord, which is free as I'm recording this, but may not stay that way forever.